Let's get started, everyone. Welcome. My name is Eddie from Juno, and it's a pleasure to be here with you. I'd love to get a sense of who's in the audience. So, if you can also use the chat feature to just post whether you are a student, a parent, a counselor, a teacher, and the grade if you are a student or parent of a student, the grade that your student is in, whether senior, junior in high school, sophomore, younger, maybe even a college student as well. I'd love to get an idea of who is tuning in here. I see a lot of parents, incoming freshman, parent of a freshman. Okay, great. Awesome. Seeing a lot of incoming parents of an incoming freshman in college. Congrats to your students for graduating. I see a student as well. Welcome, Amanda. So during our time together, I'm going to focus a lot. This is helpful for me to know about so I can specifically tailor. If there's if anyone else has an individual questions, I'm more than happy to answer those as well. You can post those here, or we can connect offline, a one-on-one, or you can via email as well. If you have specific questions related to you, but I'll keep it more general for the bulk of the audience here who really are more so parents of freshmen and even sophomores I'm seeing in the chat. I am going to ask that you post your questions in the Q&A. I will be disabling the chat now. It's just easier for me to monitor the Q&A feature with all the questions that will come in, and that way I won't lose sight of anything because in the chat they'll just continue to scroll up and up as the questions come in. So please use the Q&A feature for the chat, and that way we'll be able to focus our time together there. Now, this webinar is being recorded as well, so you're welcome to take notes, but know that you will also get access to the recording, you'll get access to the slides. All of this will be available for you, so don't hesitate to reach out. I will follow up with everyone tomorrow, and so you'll get access to this information right away. Now, let's jump in. I wanted to talk about the general cost of college, something that we're all thinking about, especially the parents or students who are in college or their students are about to be in college. You may have received the tuition bill already, you may not, or are awaiting that. So I'm going to emphasize some of the different components of that, and then also the federal loan process, and then how the changes to the federal loan process are going to impact a student and parent borrowing consideration. I'm going to spend some time also talking about the private loans, especially figuring out how to pay for college after the scholarships, and then how you might be able to find the lowest rates. Please post your questions in the Q&A throughout. We'll reserve most of the time towards the end for that, but I'll keep my eye if there are any questions that come along the way. I'll do my best to answer those, but we will spend the majority of the time towards the end with the Q&A feature. Just a quick note here on the work that Juno does. I'll talk more about this at the very end, but just to give you an idea, really what Juno is a platform that aggregates the demand. And we bring families together. This past year, we actually brought a little over 30,000 students and families who need to take out loans to help pay for college. For many families, it is a reality. Of course, we always emphasize maximize grants and scholarships first. If you can get the free money, that is great. And so minimize loans as much as possible. But in the very realistic case that many families do rely on loans to help pay for college, our mission and our goal is to get the lowest rates possible for families. And so that's the power of collective bargaining, where we bring in thousands and thousands of families together rather than you going individually to a bank or a lender. This is the power of group negotiation. So you can see if you want to find out more information about the deals that are available, the link will be here. You'll get access to the slides, so you can click the hyperlink directly. It will not be going through the process will not impact your credit score. It's a soft inquiry, and so just know that. I'll share more about it towards the end. But just to give everyone here to make sure we're on the same page, I know there may still be some folks who haven't gone through the college application process yet. And so, if so, this is the relevant timeline. Students will be able to submit, students and parents will be able to submit the financial aid documentations early. So this will be coming up in the fall. FAFSA opens up October 1st. And so I always recommend starting early. The earlier you can get your documents together, even submitted early, the better. The greater the chances that you'll be considered for maximum financial aid considerations, both from the federal government, especially state opportunities, and then even institutionally. Excuse me. Mhm. Oh, pardon me. Now, when you submit the FAFSA, you'll get the student aid index number. I won't go into depth about what this number means. Everyone who's applied already and applied for financial aid knows what this number is. It's a number that determines the amount of financial aid that a student may or may not receive. Um, then, of course, the student will apply to college. It could be in November, which is the early application timeline, or even in January, which is the regular decision application deadline. And then from there, students will receive their financial aid award. You can appeal the financial aid award. I'll speak more about that in just a moment here. But then you pick which school you decide by May 1st. And then really the summertime where we are now is when students are navigating on how, after any scholarships that you may have received, how to pay the difference. So potentially looking at student loans before that tuition due date is due. And so we host a lot of webinars all throughout the year. You'll see this from us. All of our webinars are available on our website, joinjuno.com/webinars. You can tune in there if you're curious. We will host many, many more this upcoming fall, especially as it relates to the FAFSA, the Student Aid Index. We also have a webinar on appealing financial aid. And today we're really focusing on where we are at this point in the year, in the summertime, of researching and applying for student loans. So there's many ways that families can pay for college. I mentioned these as earlier. Grants and scholarships is always the first point. Maximize this as much as possible. Apply for external scholarships. Do what you can to appeal your financial aid award to get more from the institution as well. Families may also rely on savings or income, and then also loans can be part of that equation. So we're going to emphasize and focus on knowing what the full cost of college is, because many families will focus on tuition. Even conversations I was having today with some parents, many times families will focus on tuition, but there's much more to the cost than just tuition. You'll learn how to get access and to maximize the free money sources. And then, especially if you do need to borrow, then how to avoid borrowing at high rates. So I'm going to talk about that through an example here with UCLA. And this is specifically in-state tuition at UCLA for the upcoming academic year. When we think about the cost of attendance, right, this is the big sticker price number that is on the college's financial aid website. It's required to be published on every school's aid website. For those who have applied for financial aid, it is the number that you also see on the financial aid award letter. And so that is the total cost, the all-encompassing cost. Now, this is the cost for 1 year. So it's not just tuition, right? It's also food and housing, or also called room and board. Health insurance can be a portion of that. Any kind of personal expenses or an allotment for personal expenses. This is just usually an estimated number. And then other things like books can be included in this as well, textbooks, course materials that are required. So there are billed and unbilled expenses. Typically, the billed expenses will be things like tuition and room and board, even the health insurance fee. These get charged directly by the university. Unbilled expenses can be those things like textbooks, maybe airfare or travel to campus, which you're not paying directly to the university, but there's still important costs associated with attending college and costs that you should account for and budget for in the overall planning process. Because again, if you do need to fly to campus to get to your school, that money has to come from somewhere, right? So we see this add up to about $45,000 at UCLA. Now, this is the cost for 1 year. So if you want to have the 4 year cost, we'll multiply this by 4. One quick note here, and the health insurance piece of this can be waived if parents have their student on their health insurance plan and it's covered in the state that the student is going to college in. So this can be a way that you can save a couple of $1,000s where if you have that health insurance coverage, you can waive it and you'll be required to submit a health insurance waiver. Make sure you get those completed because usually those deadlines come around the summertime or early August. Make sure you pay attention to those deadlines to get those forms submitted. Now, here's where we're going to talk about grants and scholarships and the free sources of funding that's available. Now, in some cases, at this point in the year, for the students who are about to enroll in college, usually these have been exhausted. So I'm going to focus this more towards the younger students here so that you can plan ahead. The federal government has several sources of funding and resources for students based on filling out the FAFSA application, which is the free application for federal student aid. And so the federal Pell Grant is one of the most common. Students can get grants up to $7,395. Now, that's the maximum, and it can be a range anywhere up to that point. This is typically reserved for students who have the highest financial need. So again, as a result of the FAFSA, the student aid index that you get, the lower your student aid index number, the higher the financial need is, and the more financial aid a family will receive. The Federal Supplemental Education Opportunity Grant is another one of those grants. It's funding that gets sent directly to the university, and then universities can allocate that to the students that they've determined have the most significant need. So awards can be anywhere between $100 to even up to $4,000. These are available as well to students based on the results of the FAFSA. And then finally, through the federal government, work study is an option. Now, there are specifically designated federal work study options that are campus jobs partially subsidized by the government and also partially paid for by the university. This is different than general work study. And I want to be clear here because federal work study jobs are specifically designated for students who have the highest financial need. Now, even if you don't qualify for financial aid, or even if you don't apply for financial aid, there are many students on campuses across the country who are working to help either pay for college or pay for some of those incidental expenses, books, laundry, meals, extra meals, dining out on campus. You can still get a campus job even if it's not a federal work study job. And in fact, many universities rely on student employment to help facilitate their daily operations. So many times students will work in the libraries or in the cafeterias or in the gym facilities, right? And that's a way for a student to earn additional income, save that income, and help pay for some of the costs associated with college. So there is a distinction here. Federal work study is a specific program because it is partially subsidized by the federal government. But just know that many students will have access to campus jobs through the university directly. Now, state governments will also provide aid. And I want to mention a quick note here because usually state funding is the quickest to run out. And so this is where I'd recommend being really deliberate about the schools that you're considering and whether or not the funding sources or how limited the funding sources are. Because once the funding is gone, it's gone for the year. That's why at this point in July, for any students who are about to enroll in college, there's not really going to be a pool of money available anymore. So this is very relevant for the younger students. Now, institutionally, universities offer financial aid through their own budgets. So many schools will have a financial aid budget that they can provide to discount tuition or provide financial assistance to families who can't afford the full cost. And so this is a way that you can reduce the cost of your education. Similarly, universities will offer merit scholarships, and offer need-based scholarships and merit scholarships. So both of those are really important because that can be a way for a student based on either their financial situation to get more aid from the school, or based on other factors like really strong academics, strong athletic ability, strong musical talent. There's some quality that the student has, some talent or skill that the student has that the university wants on their campus. So they will give you additional funding in order to attract you to their university over other places. So just make sure you fill out the FAFSA every year, especially even for, I should say, for merit scholarships, because some universities require the FAFSA to be on file in order to allocate or distribute merit scholarships, even if you don't qualify for financial aid. Now, in this example, I'm going to assume a $5,000 uh, scholarship from UCLA. So that's going to reduce the amount that we have left to pay to right about a little over $40,000. Now, from here, this is what's determined as the total financial need. So you have the total cost of attendance, that big sticker price number. From there, you subtract grants or scholarships, and that is the difference between those two is the total need that the family has, which is also the equivalent of the borrowing limit. So a family could not borrow more than $40,353 in this example. If the student received a bigger grant or scholarship, let's say they received a $20,000 grant from UCLA, you'd subtract 45,000 minus 20,000, and so the amount left to pay and also the borrowing limit would be a little over $25,000. Now, this is relevant because there are some universities, for example, that will distribute scholarships late into the summer around this time. And so you may not exactly know how much you need to borrow until later on. That is okay. Universities will certify the loan amount. So if there is a late breaking scholarship, let's say this student specifically, initially they may have received a $5,000 scholarship, but upon further review later in the summer, the student may get an additional $15,000 to come back to our example. So that's $20,000 in total. So then your borrowing limit would change from $40,000 to $25,353. So I hope I didn't lose anyone there just in some of the nuances, but this number can change based on the any scholarships that a student receives. But what's important to know again is that this is the borrowing limit, this is the max. It's not necessarily the amount that you do have to borrow. There's other ways in which we're going to get into, but this is the maximum amount that you will be able to borrow. So from here, we're going to assume a $40,000 amount left to pay. Now, families will oftentimes have savings, not always, but in many cases, families may have savings available to help pay for college. So in this case, we're going to assume a $10,000 contribution from the family savings. Now, if you do have anything within savings, utilizing that early on can be beneficial. And so I'll explain why. If you have enough to cover, whether it's 10,000, whether it's 40,000, or whatever the amount is, whatever amount that you do use from the savings is less that you may have to borrow in the future, or less that you have to borrow in the moment, I should say, which then reduces the amount of interest that compounds. So when you take out a loan, interest starts accruing the moment the loan is dispersed. It doesn't accrue when you sign the loan, but when the funds get sent to the university. And so let's say this $10,000 was enough to cover the first semester. It's not the case in this specific example, but if the school was cheaper and you had 10,000 in savings and you didn't need to borrow for the first semester, you've saved yourself 4 months of interest on um, uh, by paying out of pocket. And then some families will borrow for second semester if they have the savings available to cover the first semester tuition. So that is a way that you can reduce the amount of interest that you're paying by a few months. Now, in this example, again, we're going to assume $10,000 in savings. So that brings us left to $30,353. With this remaining need, we're going to focus on what the different options are and also some of the changes associated with that. We'll discuss federal loans that are borrowed by the student, federal loans that can be borrowed by the parent, and then also private loan options. So just quickly here, we're going to go in depth into each of these. But on the undergraduate side, there are different ways and pathways for students to consider, from the direct loan, the Parent Plus loan, which is a loan for parents, and then private loans. At Juno, we strongly recommend families consider the direct loan first. Usually, they come with low fixed rates. There are federal repayment benefits, and then the disadvantage here, though, is that there are low annual borrowing limits to them. The Parent Plus is another option. It does come with high origination fees, and the rate is the same for every single family. As long as you qualify, it's the same exact rate for everybody. And then there's a maximum borrowing limit of $20,000 per year. On the private loan side, again, usually there isn't an origination fee in the way that you see for Parent Plus and even the federal direct loan. But the downside is that they don't have the same protections. You can borrow up to the cost of attendance, minus any financial aid that the student grants or scholarships that the student receives. So it is a way for a family to cover the full cost if they need more. We're going to dive into each of those. But before we do, I wanted to emphasize this piece here because there are both financial and non-financial considerations when you're thinking about loan options. First are the things, the financial ones, like what is the origination fee? So what is the cost just to take out the loan in the first place? What is the interest rate? That's the most common financial metric that families are looking for. It makes sense because that's going to determine how much you have to pay for that loan. What is the rate type? So is it a fixed rate loan? Is it a variable rate loan? And then are there any borrowing limits to that? Now, on the other side, can a family qualify? And how do you qualify? So you can certainly qualify for a loan, right, sort of at a minimum threshold, but then similarly, we come back to the financial piece after that. What is the interest rate going to be if you qualify? In whose name is the loan in? And then when do you have to start making payments? What does happen if you are facing a hardship, right? So there are many considerations to be thinking about, both on the financial and the non-financial piece that are important as you navigate these different options. So let's jump into the federal direct loan. We're going to talk in depth on each of them. But with the federal direct loan, it is for the upcoming academic year, for 2026-2027 academic year, the the rate is a 6.52% fixed interest rate with a 1.06% origination fee. So again, it's a small origination fee, especially if we compare it to the Parent Plus, but I want you to all be aware of that. There is a borrowing limit to this, as I mentioned. It's $5,500 for freshman year college students. Now, every undergraduate student qualifies for this. So for the rising college freshmen, you likely saw this on your financial aid award. It may not be in the top section. Every school will list it in different ways, but usually this loan is included on the financial aid letter as an option that is available to you as a student because every undergraduate student qualifies. The student is responsible for the loan. There is no income requirement. There is no credit requirement to this loan. But the payments of this will begin 6 months after the student graduates. So you have 4.5 years. If you borrowed now, you have 4.5 years before you have to start making payments on them. Now, the reason we talk about these as the first point, if you do need to borrow, is because of the protections associated with the federal direct loan. So there are forbearance options. There are assistance programs. So, for example, the most common one was when during COVID, many students had their loans paused, so they didn't have to make payments on them. Another benefit of the federal direct loan is the public service loan forgiveness program. So if you do enter any kind of public service work, you do have the opportunity to have your loans forgiven after making consistent on-time payments for 10 years. So, and then the remaining balance can be forgiven. Now, this is a great option for many students. If you know what you want, if you don't exactly know what you want to enter into, it can be a great way for students to still have that option available for public service loan forgiveness. So the benefits that come with the federal direct loan on top of the generally low interest rate given today's market is a strong reason to consider this first. Now, the borrowing limits are set for freshman year at $5,500 for dependent students. That goes up to 6,500 for sophomore year and then 7,500 for junior and senior year. Now, all these examples, these limits that I mentioned are for dependent students, but there are opportunities for students to borrow more if they are considered an independent student. And this has a very specific definition for FAFSA purposes. It is not whether or not a student is claimed on taxes. So this has nothing to do with the IRS, but there's a specific definition. So if a student is at least 24 years old, for example, if the student is married, they're considered independent. All graduate and professional school students are considered independent. So at that point, their parents are not expected to contribute, but the student is expected to be paying for their education. If the student is a veteran or a member of the armed services, an orphan, an emancipated minor, or homeless or at risk of being homeless. The, each of these requires documentation, and so to gain the independent student status. And this is really meant for students who may not be having the support of their biological or adoptive parents. And so you can borrow a little bit more. Now, students can also borrow under the independent student status if a parent is denied the Parent Plus due to an adverse credit history. So just know that it is possible to also borrow a little bit more. In some cases, this may be enough for students for their cost of their education, and in other cases, it may not be enough. So really, if the student doesn't need more than $5,500, then use the direct loan only, and then you can be done with the process. You don't have to explore beyond that. If there's additional cost with the university beyond the $5,500 borrowing limit, then that's the next step for families to consider, both between federal Parent Plus options and then even the private loan options. I see a question in the chat here from Michelle. When should a student apply for work study jobs? Great question. Usually they're at the beginning of the year or potentially sometimes even a little bit before the beginning of the school year starts. It can be a great question to ask the financial aid office or even students who are at that university in terms of the exact timeline. So it's going to be right around the beginning of the year. Federal work study jobs, again, are a distinct category from regular campus jobs. There may be other campus jobs, like a student can be a teaching assistant for a professor, for example, and those would be coordinated directly with the professor. A student can work in the cafeteria, and so those would be coordinated through, usually universities will have a job portal where students can see available jobs online. Well, great question. So let's go into the Parent Plus options next. Now, as highlighted earlier, the Parent Plus has a high origination fee of 4.23%. So if you need to borrow, for example, $100, you actually have to borrow $104.23. And that $4.23 is the fee that gets sent to the federal government for just taking out the loan. The interest rate is the same, fixed rate of 9.07% for everyone for the academic year. So regardless of what your credit score is, as long as you qualify, everyone gets the same rate. And so the borrowing limit is new this year versus what we had last year. This $20,000 per year limit is just started July 1st, so a few days ago here for any incoming students. So that is what you can borrow through the Parent Plus. Now, a parent cannot have an adverse credit history. I'll share some examples in the next slide of what this means. But the parent is the only one who is on this loan. So the student is not legally responsible for this. For better or for worse, for some families, that's totally fine. For other families, this is not as attractive of an option because because In some cases, I've talked to parents who have their own student loans that they're still paying off. And so then having additional responsibilities and sole responsibility through the Parent Plus program can be a difficult additional burden. The default payment is 60 days after the loan is dispersed. However, it's very popular to defer payments entirely while the student is enrolled in college and through the 6-month grace period. Just know that you have to take the active step to request it, but it is common for families to do that if you wish. You can certainly start making payments within that 60 days, and that's totally fine. Um, I see a question here. If you request deferment, if you re question if you request deferment for the Parent Plus loan, will the interest rate continue to accumulate? Yes, and that's exactly correct. Know that interest does not pause. So interest begins accruing on any loan the moment it's dispersed to the university. So if it's dispersed in the fall, coming up here, let's say in September, you can defer fully for 4.5 years, but the interest will continue to add up if you're not making payments to pay out the interest or reduce the principal. So that is something to keep in mind. You're more than welcome to make payments, whether it's interest only payments, even more. You can reduce the principal balance on the loan as well if you can afford to make those payments. Absolutely. I would encourage that if you're able to, if you have the funds available, because you would pay less in interest overall. And so just know that there are limited hardship protections with Parent Plus, though. So this is an option for families who may need to borrow to help pay for college. It can be used it can be used either after the direct loan cap is hit, and this is also common if families are seeing worse rates in the private loan market, so rates higher than 9.07%. So this is where we'll talk about balancing both of them, exploring Parent Plus, exploring private options, and then which one might make more sense. Does your child have to pay taxes if getting a federal Pell Grant when you get a job from the campus? It can depend on how much they earn. If they're below the threshold, there's an income threshold. They may not have to pay taxes, but just know that it is possible where a student may have to pay taxes, depending on how much they work and how much they earn. Good question here on minus other aid received. Does that mean minus the direct federal loans? No, it means minus any grants and scholarships that the student receives from the university. So a few other great questions. Keep them coming. A few other common questions that we get. Again, this is available for parents of undergraduate students. The student does have to be enrolled at least half time in the university, and the student is not able to get this loan. They are nowhere on this loan. They're not legally responsible, so the parent is solely responsible. Um, you can access the Parent Plus loan at studentaid.gov. That's what's hyperlinked here in this section, apply here. So you can see it there, and then you would have to sign the MPN in order to get the loan. Now, if a family is denied, then this is where a student can borrow under the independent student status rates that we saw earlier. But if a family has a recent bankruptcy, a large debt that is more than 90 days delinquent, or a wage garnishment, then those might be reasons why you may be denied. If you are denied, it is possible to also then get an endorser. So that's basically like a co-signer for the parent who was denied. So it's not the end of the road. If you are denied, it is possible for you to still qualify, but you would need someone else to serve as an endorser. Now, this is the big change. And so this just went into effect on July 1st. Students can borrow, parents, parents of undergraduate students can borrow $20,000 per year, for students beginning college in fall of 2026 and everyone after that. So this is a new law that went into effect. So for the foreseeable future, potentially forever, this is going to be the limits that are in place unless there's another act of Congress that changes it. So the lifetime limit is also $65,000 per student. And so these are per student limits. It's not a per parent limit. So it doesn't matter which parent may borrow. One parent may borrow a lifetime, maybe annually 10,000, the other parent borrows 10,000. It's not the case that both parents can borrow $20,000 per year for the student. So it is a per student cap regardless of which parent borrows. Now, because it's a per student cap, if you have multiple children in college or a younger child coming after, each child or each student will have their own cap. So $20,000 annually for student one, $20,000 annually for student two, $65,000 lifetime for student one, $65,000 lifetime for student two. It's a per student limit. Now, there were, I believe, some sophomores or parents of sophomores and potentially even older that are here. So let me spend a quick moment talking about this. If you were previously enrolled in college before these changes went into effect, you can be grandfathered into the current Parent Plus limits. So it's called the legacy exception, or colloquially called being grandfathered in. And so you can borrow up to the cost of attendance, which was what Parent Plus was available before July 1 of 2026. That was the limit was you could borrow up to the cost of attendance minus any scholarships or grants that the student receives. And so the student or parent had to have taken out a federal loan before. And so if you haven't taken out a federal direct loan or a Parent Plus loan, then you would not be eligible for this. But as long as you did either one of those, either the student took out the federal loan or a parent took out a Parent Plus loan, that's one of the criteria. The student cannot transfer. I just had a conversation yesterday, though, with a parent where their child was previously enrolled in college but is transferring for the upcoming fall. If a student transfers universities, you will lose the legacy exception, and you are then subject to these new borrowing limits that you see on the right side of the screen, the $20,000 uh, annual limit and $65,000 lifetime limit. So there are a couple stipulations on the being granted the legacy exception. So let's look at what this means in real terms for families. So just as a reminder, coming back to the example of a UCLA student who's starting college, they had $5,000 in scholarships, $10,000 that the family is using in savings, and we're going to assume that the student maximizes the federal direct loan each year, and that the parent also maximizes their Parent Plus option every single year. Let's see what that looks like. So in this case, in year one, the student and family still have about a $5,000 unmet need. So that's the red part that you see at the top. Now it reduces over year two and year three because you see that the direct loan that the student can take out increases by $1,000. And so the unmet need goes down. So families would be responsible for figuring out how to pay this difference. Now, there's many ways that you can do this, right? You could take out additional loans. You could, if you have additional savings that you might tap into, work study, which is not included in here, could be that bridge of that fixes the gap here that a student has. Now, the key point to see is what happens in year four in a student's senior year. Because a parent can borrow $65,000 lifetime, and they already borrowed 20, 20, 20 in the first 3 years, they only have $5,000 remaining in senior year. And so this is the importance of creating a 4-year plan. I was previously a college admissions officer and then also a high school college counselor. And I've seen time and again, families navigating through this process. More than ever, more than ever, it is critical to set a 4-year plan on how to finance your education or the children's education. And so, because of these limits that are in place, the default option, which is the Parent Plus, is no longer the default option, right? So last year, the year before that, the year before that, families oftentimes could get by on borrowing through the Parent Plus program because it's not the best rate, but it also wasn't the worst rate in the market, right? 9% is fairly high, right? But it's a lot better than seeing double-digit interest rates. So it can be very costly to not plan accordingly and also to not realize that there may be options out there that are really expensive and untenable for the family if you're having to figure out how to pay for college. So Parent Plus is no longer the default. And so in this gap, we see an additional $29,000 of unmet need. And so, how is the family going to fill that unmet need? That's the key question. So, Parent Plus oftentimes won't be enough because colleges are now fairly expensive. And so, this is where, even if you've exhausted Federal Direct and Parent Plus options, then many families are effectively forced into the private loan market because the federal government is stepping back from the administering as many loans because of these restrictions that are in place. So let me spend a moment just talking about private loans here as well. And so usually private loans don't have an origination fee, but the interest rate is entirely based on your credit and credit profile. So income, debt to income ratio, income history, those types of factors. Most lenders require at least a 650 credit score. Some of it can be, 650 to 680. This is just to qualify, right? So if you have a credit score that is less than this is where it's going to be really important to make sure you plan long term. If your credit score is lower, that you can focus on building your credit as quickly as possible. All right, paying off any any additional debts that you might have, making on-time payments on any statements or any balances that you have. Building your credit is more important than ever. So if there are any parents, whether your if you have additional children or parents of children who might be freshmen in high school or sophomores in high school here, it is critical to spend the next 3 to 4 years or 2 to 3 years doing everything that you can to have a strong credit score. And this is because many families are effectively being forced into the private loan market given the cost of where college is today and the limited funds available through the Parent Plus program. So with private loans, the student is usually the primary borrower and a co-signer is required. A student will not be approved without a co-signer because most students don't have income or very little income. And most students also don't have a history of credit. So a student needs a cosigner. In most cases, it is a parent, but it doesn't actually have to be a parent. It can be a grandparent, an uncle or an aunt, a neighbor, anyone who's willing to co-sign on the loan. And I should say it's a US-based cosigner who's willing to co-sign on the loan. The borrowing limit is the cost of attendance minus any grants or scholarships that the student has received. And then you can choose fixed rate or variable rate loans. Payment terms will vary depending on the lender. It can be 5 years, 7 years, 10 years, 12 years, 15 years, 20 years. There's many different options across different lenders. And then you can also select from various different payment terms. I'll talk about that in a moment here. But again, know that this is entirely credit based, and usually there's no hardship protections with private loans. So just know that. This is an option. Historically, private loans have been an option for parents who have good credit and to serve as an alternative to the Parent Plus program. This is still going to be true, but starting this month, then it may be a requirement to explore private options if you've hit that $20,000 annual cap on the Parent Plus program. So a couple common questions here. Opportunities to consider the private loans is really after the federal direct. Most of these that we're talking about is after the federal direct loan. I want to emphasize that. That's the first point if you do need to borrow. Now, other considerations, if the family wants the student's name on the loan, then private loans do offer that. As mentioned earlier, for Parent Plus, only the parent is legally responsible for it. But there's a joint responsibility on private loans because the student is the primary borrower. There are lenders that also do have cosigner release options, either after a certain number of payments have been made or after a certain period of time has passed. Then the cosigner can come off the loan, and then the primary borrower, which is the student, will be responsible solely for that loan. So if you have good enough credit to qualify, this is a great opportunity to consider private loans, or also you might have to consider them if you've hit the caps. Um, I'll talk more about kind of checking rates through Juno as well, but getting into the different payment terms. It's very common to see families doing a deferred option or a fixed payment option. So if you fully defer, you're not making any payments while the student is enrolled in college, and then also through the grace period. Usually it's 6 months. It can be some lenders have a 9 month grace period. So this comes back to the original question that was also a previous question that was asked on the interest. Interest will still accrue if you fully defer private loan uh, payments as well. So interest will start accruing the moment the loan is dispersed. And for 4.5 years, interest will accrue if you're not making any payments. If you don't make those payments, it'll get capitalized on top of the principal balance, and then you'll have that higher amount as the new principal balance when payment starts. Fixed payments are a reasonable, small, usually $25 payment that families can make. This is an option to just get into the habit of paying for college. Many lenders will actually offer an auto pay discount of it's very common for it to be 0.25% off your interest rate if you connect your bank account for these auto pay payments, basically. So it minimizes risk on the lending side, and so that's why they're incentivizing families to do this. Now, if you can make interest-only payments as well, that's great because the you won't have a higher balance than what your initial principal is. And then some families, very rarely, but some families will do immediate repayment, which is the full principal and the interest amount. I always encourage families to do whatever you're able to meet the minimum payment on. There are no prepayment penalties. So if you did the fixed payment of $25 a month, great, you can do that. And if 1 month you want to pay $100 a month, or maybe a parent gets a bonus and you want to pay $1,000 towards the loan, sure, you can go for that. But you're not obligated to. But you have the minimum amount. As long as you can meet the minimum obligation, then that's the important part. A few key things to know. Families, as you're going through this process, you borrow 1 year at a time. So you apply for college every single year. You apply for financial aid every single year. So you submit the FAFSA, your financial documents on an annual basis because they're meant to account for any changes in family circumstances. So as a result of that, you also have to apply for loans on an annual basis because your financial aid package can change year to year. As I mentioned, you can pay any loans early on the federal and private side through Juno. There's no prepayment penalties. So by all means, if you can pay sooner, go for it. I always encourage that. And then interest starts accruing once the funds get sent to the school. It's not when you sign the loan. It's usually sometime in August or September, whenever the tuition due date is due. We always encourage families to apply early. I know we're already in July, so rates can change on a month. They do change on a monthly basis, and they can change even week to week. The approval process takes about 1 to 3 days. Sometimes it is instant, but usually it's 1 to 3 business days. And then from there, the school will also have to certify the loan amount. So this is where we're really getting into that time where families are after the 4th of July holiday. A lot of families are turning their attention to this. It can take a few weeks, I say budget 1 to 2 weeks for the school to also certify the loan. Depending on the time of year, right before the school year, a lot of financial offices are very busy, so it can take a little bit longer. But understand the disbursement period. And so if the school's on the semester system, the school will provide the dates that funding that the tuition due date is due, and the lender will send the funds directly to the school. So the family doesn't have to worry about that. The lender and the school will communicate to send the funds. Um, so when you do apply, it is helpful to secure rates early on if possible. When you do submit your application, those rates will get locked in for 30 days. So you have the opportunity to still explore other options, to still shop around. As I mentioned, the shopping around period, if you do explore many different options, it'll count as one inquiry on your credit report rather than multiple. So explore, 5 different lenders. You can apply to 5 different lenders, and then as long as you do them within a 30-day window, it'll count as one inquiry on your credit report rather than 5 separate inquiries. A few things as well, just some Juno negotiated benefits that we have. All Juno families get a 1% cashback bonus or can get a 1% cashback bonus on the amount of their loan. Um, if you do have, if you do find a better rate through another lender, we can rate match with 11 different national lenders as well. So we have a rate match program where you get the same low rate that another lender might be offering you, plus we then increase your cashback bonus to 2% instead of 1%. So if you need to borrow $30,000, you'd get a $600 cashback bonus. And then that's something that you can use. It's a digital check that gets sent to the family. You can use that to pay back the loan if you wish. You can use that for textbooks, for transportation, airfare to campus, or anything like that. A few important notes here that I'll mention as well. There is no cost to sign up. So Juno is free for all families, for all students. It has been free, it always will be free for families. We get paid a small portion on the loan volume that we originate on behalf of lenders. And so that's how we're able to keep everything free for families. All of our resources, whether you're interested in undergraduate, graduate programs, please check out the resources we have on our website. We're always, if you have ideas or if you have specific needs, let me know. We have the bandwidth and ability to constantly create new resources. So let me know if there's anything that would be helpful. There's no hard credit check if you check your rates through Juno. Just be mindful because this isn't true at all lenders. Even if you go directly to lenders, there are lenders that will pull your credit, so it'll be a hard increment in your credit report. If that happens, it's not the end of the world, but just know that that 30-day timeline has that clock has started. So I would encourage you to expedite your search and not wait if your credit does get run, because you don't want to have any unnecessary multiple inquiries on your credit report, if it's beyond the 30 days. On Juno's platform, all the lenders that we work with, there's no hidden fees. You also have the option not to pay while the student is in school. And importantly, we have free one-on-one support. I meet with families on a daily basis. We have a whole team for this. So if you have any questions, feel free to reach out to us at any point in time. We'd be happy to discuss what your options are, whether it's private loans, whether it's federal loans. Just if you don't know where to start, let me know. I'm happy to have those conversations with you. And so this is the basic Juno model where again we bring families together for the to negotiate, and then we also have specific benefits that we've negotiated, like a rate match guarantee. So all you do is shop around. If you find a lower rate through an eligible lender, then you email us at hello@joinjuno.com, and then we can take it from there. Happy to talk more details there, but let me see. If you want to sign up, I'll leave this up because next we just have Q&A. So I'll leave this up here if you want to learn more about what the rates you may qualify for. And then please feel free to post your questions in the Q&A. So here's a question from Amanda. If you borrow an annual amount, does the loan disperse the entire amount in the fall, or will the lender disperse the second half automatically in the second semester? Typically, it's the latter. So the lender, whatever the system the school is on, so whether it's a semester system, a trimester system, or a quarter system, the school will communicate with the lender when the funds are due. So I'm going to use semester because it's the simplest to think about. So the funds would get sent early in the first semester, so right around maybe late August, early September, depending on when school starts. Funds will get sent in, half the funds will get sent at that point in time, and then the other half of the funds will get sent in January when the second semester starts. How do we request a one-on-one meeting? Let me, um, I will actually paste my direct um, Calendly link in the chat here. Let me pull up the chat. Okay, so I just pasted the juno.us/Eddie takes you directly to my calendar, so you can sign up for a time there. Let me also, I'm going to paste, include my email as well. So I just posted both my calendar invitation link and my email if you have any additional questions. If you have any questions that you prefer not to ask in an individual, excuse me, in a large group setting, I completely understand that. This can be a very personal process. It is a very personal process for families. So feel free to reach out to me either via email or to sign up for a time to chat. In deferment or forbearance, does interest continue to accumulate? I believe so. I will double check, Teresa, and then I can let you know. If you send me an email, I'll confirm that. Okay, here's a question as well. So why would a student take out the federal student loan if they can get a private loan at a lower interest rate? Are the federal benefits really that much better that they should always take the federal loan first rather than the lower interest rate? Good question. So I also had this conversation with a different parent today, who went through the rate check process, qualified for a very low rate, like extremely competitive. And I told that parent, make sure you take this because it's not common to see the rates that they got. So in those cases, absolutely, like if you see rates lower than 6.52%, which is the federal direct rate, then you can justify it from the economic perspective that it's actually more advantageous to take out the private loan. Now, again, it's up to you to decide whether or not, and you can run the numbers on it to see what would be better based on the interest you pay at a 6.52% versus what you would pay at a lower rate. The big benefit of the federal direct loan that's in the student's name is the public service loan forgiveness option. And so it is possible to have a student's loans forgiven. Obviously, that means that they have to be making payments for 10 years on that loan, right? So if you have to calculate having that loan at a 6.52% for the duration while the student's in college, 4 years, 4.5 years with the grace period. So 4.5 years plus 10 years of making on-time payments. So 15 years basically. You can run the numbers and ultimately if it is cheaper to if you're able to qualify for a lower rate and then through the private loan market, that is a viable avenue for a family to go. We usually recommend federal direct loan first because, again, just where the market is today, rates are generally high, and especially on undergraduate loans. I want to be upfront about that. Um, you will see usually higher rates than graduate school programs because graduate school typically is more certain graduate programs are usually more tied to income and earnings expectations. Undergraduate lending is considered the riskiest of student lending. And so that's where you'll see many families are seeing rates that are actually higher than 6.52%. Um, but of course, if you see something lower, then that's where the conversation can be had to explore. You're not forced and you're not obligated to take out the federal direct loan. You don't have to take the $5,500 loan. Um, so there are some circumstances in which it may not make sense. Where do you get info on the Stafford loan? I can, if you send me an email, I can send you the link. You can find it's going to be on the FAFSA website, and so inform if you actually need to accept the loan, you would do that on the school's financial aid portal. So the funding does come through the school or through the school's portal. Great questions. Keep them coming. If anyone, I see the time here now, we're a little bit over. If anyone does need to head out, totally fine. Thank you so much for joining. I will stick around as well. I see a couple other questions that are coming in here. So I'll just stay until I notice that the volume of questions has subsided. Um, in the console, do you walk through the Juno application or should I do that first? It is helpful. I recommend doing the rate check first. That's not an obligation to take out a loan. It's just the preliminary rates that you qualify for. It's always helpful to have that on hand, just so you have an idea of um, where you are. And then from there, we can think about what makes sense. So to the question that was actually asked earlier, um, Teresa, the question you asked about, does it always make sense to take out the federal direct loan? This is exactly a conversation I had with a dad earlier today, who qualified for that much lower rate, but it was helpful to know the rates that they qualified for. So usually do the rate checks, which is the slide that you see here on the screen right now. Do the rate checks, see what you qualify for, and then that's where we have more information can be helpful in the conversation. Stafford loans are not tied to financial need. So the student does need to fill out the FAFSA in order to access it, but it doesn't have to. It's available for all students. So regardless of income level, as long as the student is an undergraduate student enrolled at least half time, then they're eligible for the Stafford loan. That's the $5,500 freshman year loan. And again, that goes up to $6,500 sophomore year, $7,500 for junior and senior year. I'll give it another minute or so. Let's see if there's any other questions that are coming in. Yes, the Stafford, yeah, you can still request the Stafford loan. So the fiscal year started this July 1st. So it goes the calendar year, excuse me, the fiscal year for financial aid goes from July 1 to June 30th. So you can request the federal direct loan for the upcoming academic year. Okay, so here's a question that came in. Received a bonus, so I can pay for this semester college, but do I look for a loan now for next semester? Great question. So, again, it's excellent if a family can pay for the first semester. That's great because you're pushing out your borrowing needs, which is great because then you're accruing less interest over the first semester. It's up to you. You can explore now, or you can explore later in November, December. It's hard to I can't predict where rates are going to be in November, December, right? I can't predict where rates are going to be next month either. So if you can certainly apply now, lock something in, and from there, just make sure you communicate with your financial aid office that you don't want the payment to go towards first semester, but you want to apply to second semester because you're planning on paying in full from your own funds. So it's up to you. So I would recommend you can actually apply now, see what rate, or you can do a rate check now, see what rates you qualify for. If you like what you see, apply, lock it in, and then you can cancel your loan at a future time. So, rates can go up and down. You would have a lot more time to see those fluctuations in the market. If rates go down in future months, excuse me, then you could cancel the loan that you have existing, as long as you cancel before the loan gets sent to the university. And then if rates go down, then you can reapply for a new one and then cancel the old one. And similarly, again, like credit scores will fluctuate as well. So you might have a stronger credit score in 4 or 5 months from now than where it is currently. And so you might be able to see better rates, later on. There's a lot of factors that contribute to it. Any other questions? Good question here. Are there prepayment penalties on private loans? Um, I can't speak for all loans because I'm not sure. I know the ones that Juno is partnered with, there's no prepayment penalties. I can say with absolute certainty there that there are not any of those prepayment penalties. There aren't prepayment penalties on federal loans either. So if you do the direct loan, the Stafford loan, or the Parent Plus, I can't make the same overall statement for all private loans just because you'd have to double check. Usually there aren't, but I can't say for sure. It would have to be lender by lender specific. Oh, here's a good question, Grace here. So, in the Juno application, it asks for the loan amount. Am I requesting for the semester or for the year? I would suggest you request for the full year, and I'll explain why. The You can certainly go at it on a semester by semester basis. However, if you know the amount that you need to borrow, which is typically, and college expenses are generally going to be fixed. Once they set tuition, the amount is going to be fixed. Um, then apply for the full year. So this is different than the previous question we had on the parent who was able to pay for the first semester and then is looking for a loan for second semester. That's separate from what I'm about to share here. In this case, you'd want to apply for the full amount because you don't want to have your credit run unnecessarily. If you apply on a semester basis, then your credit would get run in now for the fall and then sometime later for the spring term, right? And that's not really necessary. You can lock in a rate now for the full year, and then those funds would get dispersed because the lender communicates with the school on when those funds have to get sent. So you don't have to worry about that. That happens on the back end. But that's why I recommend applying for the full amount, and then the loan will get split by semester for to the school, and then you're not having a second inquiry on your credit report. I've seen a couple questions sort of trickle in here and there late, so I'll still wait. Maybe I will give it one more minute. I'm grateful to all of you who are still sticking around. Um, and so feel free to post any other questions that you might have. I'll give it another minute or so. All right, I'm not seeing anything else come in. If there's any other questions you have, my email is in the chat. I shared the Calendly invitation for signing up for a time if you are interested. Let me know how I can help. We're here for you at Juno. We want to be available. I understand it's a stressful time for many families. It doesn't have to be, but let us know how we can help. Hope this was helpful to all of you. Reach out with any additional questions, and I wish you a wonderful evening. Take care, everyone.